Good morning, everybody. I am John Wilkinson with the Living Colorado team. I'm here with Nathan Jennison with Mortgage Architect. And obviously, I'm not Kinder Ruck. She is in the Pacific Northwest, reveling in the beautiful weather that they have, or that they're having right now up there. So, Nathan, good morning.
Good morning. How you doing, John?
Doing well, doing well. Love to talk to you this morning a little bit about not just ARMs, but in general. Kind of, I think a lot of buyers we've talked to have questions about when are rates going to drop, or are they going to drop? I don't think that they know, or many people know, kind of what impacts mortgage rates and kind of what we're looking for. If ARMs are a good option or not a good option, we'd just love to talk to you a little bit about that.
Yeah, absolutely. It's a great question. So, I get asked about arms fairly frequently, and a lot of people, especially people that are more educated, that are really trying to find an edge to the market, are looking at arms at this point. There's modest improvement in terms of rate going with an arm. The problem that we have here is that it's not for the risk that it ends up having. It's a real question about whether or not it's worth it. And the reason why I say risk is because nobody has a crystal ball. Like, this industry as a whole, myself included, has been calling for lower rates since 2023. And it's now 2026. We still have rates in the high sixes. And the reality is that there's a lot of things that are actually impacting rates that are unexpected, that are world events, that are from other countries. And we don't know how to factor that, into the future.
Yeah, I'm a buyer, have been a buyer as well. So it's one of those things where people have said, or in our industry, rates are going to get better end of 2026. This was last year. And obviously no one knew that the Iran war was going to happen, or any of these events, globally, were going to happen. How do those events or kind of foreign financial movements affect mortgage rates here in the States?
Yeah, that's a great question. So the reality is that we have a world economy. So what happens? I mean, obviously, Iran, that situation has spiked oil, which has basically created a lot of inflation fears, which have been bad for mortgage bonds, and so that's caused mortgage rates to go higher. However, like, there's other issues too. Like, Japan is having a lot of issues with their yen, and so how they're dealing in terms of, are they selling U.S. bonds and treasuries, like, that has an effect on what happens with ours and with those yields, and then that filters through and affects mortgage interest rates. Even trading technical levels have a massive impact on mortgage rates. And it's not even being driven by news. It's really just being driven by different Fibonacci levels and where traders are basically positioning. All of that filters through and affects the person who's trying to buy a home.
So the other thing I've heard too is when the Fed either drops rates, that it doesn't really have a direct impact on our mortgage rates. So, like, let's say they want to help kind of bring rates down. What would need to happen for that, for us to actually see that effectively in the mortgage rate industry?
The interesting thing about that is that when the Fed is going to drop rates, mortgage interest rates actually see improvement ahead of that decision. When that decision is actually made, mortgage rates tend to do the opposite of what everybody expects. So everybody's like, hey, rates are going to drop. And at that point, they go up. And the reason is because it's basically that news is getting priced in based on probabilities of what the market is expecting the Fed to do, whatever signals the Fed is giving. And so, again, it's like, for people to try to position and try to time the market, it doesn't work very well. In terms of what we need to see, the funny thing is, like, right now, we are getting all of the signs that we need to show for lower rates. We are getting weaker inflation data. We're getting a weak jobs market that, unfortunately, bad news is often good news in terms of mortgage interest rates.
Right.
We're getting, even a retail sales report that came out on Friday, it was way weaker than expected. And so all of those things would be pulling us to basically have lower interest rates. But this morning, rates are going up, and they're going
Wow.
up based upon, tensions with Iran, but they're also going up based on trading levels.
Wow. So bottom line, I think what we've learned this morning is ARMs may be a good choice for some buyers, but really it is truly a risky move, because we don't know what rates are going to do. We've seen the last 3 years rates, we've wanted them to come down. Everyone's kind of hoping for that. I know a lot of our buyers have been waiting, for that to happen, and just has not, we've not seen that. There were little dips along the last 3 years, but nothing significant. So I think bottom line, ARMs may not be a great solution, maybe looking for getting the lowest price. I think if we look at it that way and maybe wait for rates to drop and do a refinance down the road.
Yeah, and just to take that point one step further, the reality is that what happens, and I see this with refinances all the time. I'll reach out to a customer and I'll be like, "Hey, now's the time to refinance." What's happening is that there's a trend of rates coming down at that point, and people expect that that trend is going to continue. So if you have a lower position and you know you're going to have to refinance before that arm resets, then essentially what's going to happen is when it's you hit that point, if you're like, oh, maybe now's a good time, but the reality is you go, but if I hold out a little longer, I'll get a little bit better position. But then the market reverses and reverses quickly, and you lose that opportunity. And
Mm.
so you'd be far better positioned to get a killer seller concession. And if you need that lower rate, use part of that seller concession to buy down the rate in that instance, if it makes sense. I mean, it's part of the conversation because every day is a little bit different position in the market. But if you really need that lower rate, that may be a better use of money in respect that the seller is essentially paying for that lower position, and you're not taking on greater risk.
Nathan, thank you so much for all of this information this morning. Super educational, and I hope everyone listening has taken something away from it, positive or just for educational purposes. Thanks so much.
Always my pleasure, John. Thank you.